Thank you all for coming. I apologize, when we were in a meeting previously, my ESPN football alerts went off a couple of times, so if they go off in here, I might need to stop and replace the player. So this is going to hopefully be interactive, and I'm sure, as I talked to David, he said everybody comes up at the beginning and says it's going to be interactive, and then nobody ever makes it interactive. And mostly it's probably your fault more so than the speaker's fault, because you hesitate to lift your hand or shout out or whatever the case may be. Please, please, please ask questions as we go through here. Please, I can tailor the conversation anywhere we want to go. This is really meant to be an overview and provide a skeleton for a conversation, but I want it to be interactive. I'd like if people have questions about finance or investment banking, real estate macro market, what's happening with the Fed, how do different things impact real estate, whatever the case may be, let's talk about it. Because I can tell you that talking through things and working through in a collaborative fashion is really the only way to be successful in the long run in whatever it is that you're doing. The things that we do and the things that I do every day, I work with other people, right? That's the biggest part of it. And you share ideas, you share concepts, and everybody's got to pull the rope, right? I mean, you can't have people that aren't pulling the rope, but you need to have input from other people. So I'm counting on you today to provide some of that. Intro, as David said, I was a Florida grad in 1987. Identified it today for people. It's a year before Emmitt Smith started at Florida, 4 years before Spurrier started at Florida. And then after I went to school here, I went to law school, practiced law in Atlanta, practiced real estate law in Atlanta for 3 years. Thought I wanted to do something more on the business side than the legal side. Billing hours daily is a rough life. And I went back to business school. Worked for a summer at Kidder Peabody, one of the investment banks in New York. That summer there was a bond trading scandal. Kidder Peabody blew up. Got sold in September, October that year to Paine Webber. I liked investment banking, I just didn't really care for New York. Maybe it was the process of going through a bond trading scandal at a firm. I was going through all that on the front page of the Journal every day. The firm was owned by GE, Kidder was, and they sold it. And I found my way back to Florida, fortunately. I went around looking for other investment banks, looked at Raymond James, looked at Robinson Humphrey, which was in Atlanta, looked at was A.G. Edwards at the time in St. Louis, really looking at regional banks that were doing a lot of the similar things, but not in a New York environment. Don't get me wrong, I like New York fine. I have a lot of friends that do or did investment banking in New York. It's a different feel, right? And I was from Florida and I wanted to try and make it down here. I thought we could found a great firm. We could do a lot of the same quality work as the people in New York are doing, and do it at an environment where the cost of living was a lot lower, and hopefully the quality of living was a lot higher, at least from my personal perspective. And I think that's a theme. If you want to talk about bigger, broader themes, we can talk about that theme of major metropolitan areas and the potential for the secondary, tertiary markets, particularly in the Smile, in the Sun Belt, in places with good climates and good political tax structures for business, and the attractiveness of it. And you have, we can get to it later, but you have some people in Tampa. I don't know, anybody from Tampa? This is an easy interactive question. People from Tampa. You've got Jeff Vinik in Tampa right now. Jeff Vinik owns the Tampa Bay Lightning. He was a huge fund manager. He ran the largest, I think probably the largest mutual fund in the world at the time, Magellan, right after a guy named Peter Lynch was running it. He left Magellan, started a hedge fund, made $1 billion, the American dream. And then he bought the Tampa Bay Lightning, he moved to Tampa, and now he has bought up a good bit of downtown Tampa. and he has huge development plans for downtown Tampa. I mean, the amount of money that they're going to sink into the city of Tampa is phenomenal. It really takes somebody like him, and he's partnering with Cascade, which is Bill Gates' family office. And it's going to be billions and billions of dollars, office, hotel. They're moving the USF Medical Center downtown. It's really going to transform downtown. And I think that kind of thing is happening in a lot of different places around the Southeast. I mean, we're entertaining, give you an example, I have a client coming in tomorrow morning to meet with us to talk about an IPO, and they are a company that's focused on mostly southeastern secondary, tertiary office markets in cities like Richmond or Nashville, Memphis, cities with some, I think, a lot of good vibes going on. I don't know, anybody from St. Pete? That's kind of the same question as Tampa. Are you from St. Pete? Lots of good things going on in downtown St. Pete. I mean, people think St. Pete, and maybe many of you do think St. Pete, and you think gray-haired folks. Unfortunately, I don't have gray hair yet. But there's a lot of dynamic things going on in downtown St. Pete. The amount of development, if you go down into downtown St. Pete on any night of the week probably, but a Thursday, Friday, Saturday night, there's a lot of people on the streets and a lot of good vibe going on. So there's a lot of good things. What I wanted to say on this slide before we got going is from a macro environment, it is a good time to be involved in real estate. I think you're very fortunate. It's a little bit of luck sometimes about what the economic climate's like when you're coming out of college. If you're coming out of college or out of this master's program 10 years ago, it might have been a bit of a different story. Some tough times then, but for the most part, the broader macro real estate environment is very good for most all property sectors. And that's good for whether you're going to be involved in the ownership of assets in some form or fashion, providing services to owners of assets, brokerage business, development business. And I think the demand for real estate for all, and we can talk about retail in a second, but the demand for most all of the other asset classes is in pretty good balance supply demand wise, and there's a decent amount of development going on. So to the extent that you're interested in development and development finance and that sort of thing, there's opportunities there as well. The Fed has kept interest rates low for a long period of time. Seems like they keep bumping them up. How much impact that's going to have on the longer term rates is not clear to anybody. I don't think it's clear to them. The 10 years, it's still just over 3% now, which is as high as it's been in a while, but still historically low level. And from a real estate perspective, you say, well, why does that matter? It matters because capital and capital cost is, I think, really the engine, the driver of real estate in a lot of ways. And if your biggest capital provider is debt, which it often is in most projects, and the cost of that debt is lower, then it makes projects pencil better. So let's talk about real estate finance and investment banking. It gave me a pretty broad guidance as to what to talk to today, and I'm very impressed with the interaction that I've gotten so far, I gotta say. It's like I can't even stay on track. There's so many questions coming from the audience. But so real estate finance, real estate investment banking, there's all different kinds of jobs. Who is interested in kind of the ownership side of the business? Anybody ownership side of the business? Has anybody in here bought an investment properties before? Okay, and when you've bought those investment properties, like, how did you finance them? Was the financing side of that business, where would you put that in as the overall, and you were looking at the project, the importance or the difficulty in doing the project? I mean, did you finance it yourself or did you finance it with others?
I put in some myself. I always found it was difficult to raise money ahead of time. Typically, you want to try to put a deal under contract first.
Right.
Get the money, which sounds backwards, but then people actually can conceptualize where their money's going, so that tends to make the process easier. But you raise equity money from others, and then you'll get standard bank financing for the
Right. And the people that you raise money from, are they people that you knew or had some close relationship with?
Close relationships.
Yeah, friends and family kind of stuff. How about you, similar?
Yeah, for me it was equity, but for, I guess, bigger properties, I always found it pretty difficult to acquire them because of the lack of capital.
Right, to find that money. The lining up of the money is, I mean, you'd be surprised how many people that will come to me or call and say, look, if you could find me $500 million, I could be really good. Yeah, I mean, that's true for most people. That is a core function of real estate. Capital raising is a core function of real estate. And the people that end up going on and doing things from an ownership principle perspective, that money raising is in the relationships with capital is one of the kind of the keys to their success. There's other things you can do in real estate, though. There's a lot of different things you can do in real estate. There's the operations side, there's asset management, there's property management, there's leasing. Your big brokerage companies will do these types of things, whether it's CBRE or Cushman or JLL or whoever the lists are of the big brokers. They do a lot of these different things. There's development in the entire development process, and you say, well, what's development? It's taking nothing and making it something, or taking something that was there and turning it into something else. It's the standard over here, whichever direction it might be. So the people that develop Landmark, or the people that developed the standard, is a group called Landmark out of Athens. And we know those guys a little bit. We've talked with them in the past about trying to do different things with them, but they really have a lot of really good access to capital partners, and they've had early success on deals, and they have a list of capital partners on the equity side that want to do deals with them. And they've been successful in doing student housing all over the country, which has been a kind of a boom bust, hot cycle, hotter sector. Although from the public markets perspective, I think you haven't seen it be as successful as some of the public markets wanted. There was 3 companies and now there's 1 because 2 of them have gotten taken out. The construction side, I would imagine most of the construction stuff is more building construction, BCN kind of stuff, the actual construction. But as a developer, you're going to have to know and understand that side of things, how to find the right GC, and know your way around the construction process. And I can tell you as a lawyer and also as an investment banker, when you talk about big projects, that relationship between developer construction company, if there aren't 10 lawsuits every time, there's 20. It's a pretty contentious process at times. Asset brokerage, which is a huge business on both the commercial side and residential side. And most of what I'm going to talk about today will probably be more commercial side of things, although there's a little bit of a blurring of the lines from the public markets perspective, and in that you've had several REITs that have sprung up over the course of the last 5 years that are focused on single-family rental. So they buy residential properties and they rent them out to individuals, much like a multifamily company, except they're buying, single-family assets, and that's become a really, really big business. Mostly coming out of the global financial crisis, you had firms like Blackstone that put billions of dollars into it, and now they have a company called Invitation Homes. You have American Homes for Rent, which is a company that was started by the original founder of Public Storage, that we actually did the first private capital raising for. 7 years ago, the first outside private capital raising. He funded the business initially with $300 million of his own money, which is awfully nice to be able to do. Most people can't do that, but he was able to do that, and then he has raised billions and billions of dollars, first from us, Raymond James, through our retail system. Next, he raised a bunch of money from the state of Alaska, I think it was, that he raised $400 or $500 million, and then the company has since gone public and raised lots of different capital, a lot of which we have helped with and created new securities. We created a participating preferred security for them that was a unique and hadn't been created before. And then there's the finance and advisory side of the business. And I put my watch away, so my my phone away, so I have no idea what time we're going to be here, and the Monday night and the Thursday night football game is going to start, and you guys are going to be bummed. So, oh, okay, there you go. So finance, advisory, capital markets, that's the core of what I'm here to talk about. It's the core of what I've done in my professional career. And it's not just investment banking, though. I think investment banking is one part of that. Real estate finance is a huge business and has many, many different components to it. So real estate finance, and I'm sure you guys, I didn't ask for a textbook to see what you're teaching or get a syllabus and see the types of things that you all are learning in here. But big picture, real estate finance, think of it simply, lots of complications off of this, debt and equity, right? And that's true whether you're going to buy a house or whether you're going to buy a shopping center or a multifamily property or a portfolio of industrial buildings. You're still going to source it with two primary sources of capital, debt and equity. And debt is typically the majority of that. I'd say typically somewhere between 50 and 90, probably say 60 to 70 is probably average. Equity is less than that. And then you can put things in between it. You can put mezz, you can put all kinds of structured products in between and tranche it up 99 ways to Sunday on the debt side as well. Just a little bit of what got us into the financial crisis the first time around, but doesn't stop people from trying to do it again. If there's a will, there's a way in the finance world, believe me. And if there's money searching for a home, investment bankers and other people will figure out a way to try and find a home for it or a fit. So you've got all kinds of different providers of debt. You got your commercial banks and your pension funds, your insurance companies for more permanent debt, right? I mean, they have long-term liabilities, these pension funds and insurance companies, and they're trying to match their assets with their liabilities. And so if you're a pension fund and you're looking out 30, 40, 50 years and trying to figure out how you're going to fund your pension obligations, you want to have longer-term assets as well. And so you can have longer-term, typically pension funds and insurance companies, longer-term fixed-rate debt, but they'll buy all kinds of different stuff, right? I mean, you've got debt-focused private equity funds or non-bank finance companies. You've got mortgage REITs, and then you've got some public bonds that can be issued for public companies or larger private companies. And then on the equity side, I think that's the key. I mean, even though debt is the biggest part of it, any real estate deal really finding and gobbling together the equity is the hardest part. And if we were sitting in here and we wanted to go out and we wanted to buy the Standard, right? So we call up the guys at Landmark and say, we want to buy it. The question is, how do we finance that? We can probably find a list of banks to lend us money at fairly similar terms, fairly similar. But the big thing is, how do we find the equity? And how do you find it when it's the first deal that you're doing as opposed to the 100th deal you're doing? It's a little bit easier once you've done 100, right? So the evolution of how people finance real estate usually starts out a little bit like we were talking about, right? First one is you do it yourself. I mean, you figure out a way to cobble together the equity if you happen to have enough, and maybe that's to buy your house. But from an investment property perspective, you fund it yourself. You fund it then with friends and family, with people that you know and that you can get to trust you. And then you start to widen that out. And once you start to widen the net where you're asking for money from people that don't know you, it becomes more difficult, right? I mean, just like think about somebody calling you up and saying, hey, can I get 50 grand to invest in this deal? Well, if it's your brother or your sister or your aunt that's asking, then you've got a little bit of a comfort level. But if it's just somebody that you kind of know or somebody that got introduced to you, it's much more difficult. So things become more institutionalized, more difficult once you start to remove personal relationships from that capital. And what you see is private companies, oftentimes they get to different levels in here. Let me see if I can use this pointer. Look at that. they get to friends and family, and maybe they get to this next level, right? Family offices, high net worth local. You might have called them country club deals. I don't like the name country club deals because it sounds kind of snooty. But it's really, I think a country club deals is to be local investors investing with kind of local people. You know, Gainesville doctors or lawyers or other people that have a little bit of money and they want to invest in a deal, and they've got some friend in town that's doing a deal, and so they get paired up. But there's not that quite the same personal connection with relationship. And then you start going further out than that. And so a lot of companies that we see, in fact, the company that I'm seeing tomorrow has put together a portfolio of, it's small for the public markets, but it's a portfolio of about $400 million worth of assets, of office assets. And most of how they funded it down to the family office's high net worth level. But those people tend to have limited pockets, right? I mean, they're only so deep. And they might be able to invest in one deal with them and then a second deal with them, and then they'd love to do the third deal with them, but they need their money back from the first deal. And so you either, as a real estate entrepreneur, you need to figure out how to cycle that capital if you're going to keep building it, but then it's hard to build a portfolio, right? I mean, you do project 1, 2, 3, then you have to sell 1 to do 4 and sell 2 to do 5, and you always kind of run in with 2 or 3 projects and there's a lot of people that do that and can become very, very successful, but it's harder to build a big company. And sometimes you're building a service platform that sits on top of that you want to continue to grow, right? I mean, you've got an asset manager that you've hired, you've got acquisition people that you've hired, or if you're in the development business, you've got site selection people and other things, and you're building this group, and you kind of got to keep the train rolling, or else there's no way to pay everybody. And so to continue to grow these companies, you got to figure out a way to find larger third-party capital, and that's typically where an investment banker or a third-party capital advisor would come into play. And then what we do is we look at a particular situation and we help them understand what their options are. Most of what I do is for equity, not debt near as much, because it's more straightforward, and there's mortgage brokers and so forth that can help on permanent debt. But I have a bank that's part of Raymond James, and we can help talk with them about financing and so forth as well on the debt side. But it's equity, and it's trying to figure out, okay, what's the next, where do you want to be? And how do we help you get to where you want to be? And sometimes people don't know where they want to be. And we help think through, this option or this option or this option. Private capital, what type of private capital? Is it pension fund, insurance company, direct kind of capital? Insurance companies are often direct. Pension funds are somewhat direct, but not a lot with partners. They tend to invest in their core real estate holdings, which would I say they might consider core. You guys use the word like core real estate. Core makes sense. So their core real estate stuff, their A stuff in top markets and so forth, they tend to want to own by themselves. And they might have a third-party property manager that runs it, but they don't want to have a partner in it. So if we owned an asset and we wanted to raise a bunch of money, they'd rather just buy it from us than they would be partners with us. That being said, there's a little bit of willingness to do some JV stuff, but most of the pension funds are direct. Most of the stuff that they do from a JV partial ownership perspective is the higher return stuff, and they tend to, as do a lot of these capital sources, they tend to go through intermediaries to find those intermediaries being real estate private equity funds. Blackstone, I mean, you guys familiar with the Blackstones of the world? Apollo, KKR, the bigger, and then, I mean, there's private equity funds in Florida. RAM, anybody know the RAM folks? Casey Cummings is a childhood friend of mine, who's the CEO. And so that raising of that capital and then going out and finding that capital is a really big process, and it's one that the more you can dig in and you can try and understand how money flows and so forth, I think it gives you a good overview of the overall business itself. And then you can talk about public stock issuance, and that's I sit on both sides. We fund a lot of companies privately with private capital sources. We did a very large timber deal in the timber space. Timber happens to fall under real estate and under my purview. And we did a very large timber, like $1.5 billion timber deal that was a large structured joint venture with a private company. So the private company called Catchmark owns the equity, and then there was a lot of private equity capital sources in there in mezz, kind of different structured equity, and then there's some debt on it. And then we can sit at the investment bank, like the group that's coming in tomorrow, and tell them if there is a legitimate path to being a public company and why, what it takes to get there, what metrics people are looking at, what are the key marketing ideas, and the keys really to having a business. And it's gotten a lot more difficult. Okay, when I started in the business 23 years ago, a question. Hallelujah.
So this equity from the pension funds, you're not going directly to the pension fund. It's money that these pension funds have invested into certain private equity companies' funds that you're tapping into. Does that make sense?
It does, and it's both. So you'll take a giant pension fund. Take the state of Florida. I don't know enough about all the state of Florida's investments, but I saw the other day that the state of Florida was investing in one of the private equity funds that's getting raised right now, right? So you've got the state of Florida Public Pension Fund, which I think sits over the top of a lot of different municipalities, right? And I think the municipalities aggregate their money and it goes up and gets managed by a Florida State Pension Fund. And I might be speaking out of school, so don't quote me on all that, but it's close enough. They got a lot of money and they're running it for the pensioners. If you think about that, running that money, they have a chief investment officer there that's in charge of how do I allocate all that money. So I've got $100 billion. I don't know what's in the state of Florida. Let's say it's $100 billion. I'm going to put X amount in fixed income, and I'm going to put X amount in equities, and I'm going to put X amount in alternatives, right? Hedge funds or private equity funds or something. There's a portion of that might go direct real estate. So the state of Florida might own directly certain assets. Typically, they might do that through a pension fund advisory firm. That'll take a fee to help them, but they are the 100% owner of the asset. So they might buy, I'm going to keep using the standard just because it's there and it's new. They might buy that and they own it, and it gets asset managed by a pension fund advisory firm, because they don't have the infrastructure at the state of Florida to really underwrite all these deals and look at all of them. But for core real estate, they feel like they've got the ability to do some of that. For others, and it depends on what different pension funds, it depends on where the money is coming from, but for others, that falls more into the alternatives class or the hedge fund class, and so it gets put into private equity funds. So the state of Florida might also have direct investment in real estate, but they also own or have committed capital to Blackstone, a Blackstone fund. And so they're allowing Blackstone to invest their money typically on higher return, some type of value add. Something needs to be done to the real estate that they don't feel that they have either the ability to underwrite, either the people or the expertise to underwrite those types of deals, or to execute on them. Investment banking. So what does investment banking do? I think if you would ask my grandparents or my parents, they still don't have a clue what investment bankers do. I told them I worked at Raymond James. They always wanted to know a good stock to buy. Really, investment bankers, does everybody feel like they kind of know what investment banking is, don't know? I mean, I can tell you when I was in college, I had no clue what an investment banker was. We work primarily with companies to try and help them raise capital or think about their longer term capital plans and growth plans, and then also help them as they're thinking about whether it's M&A transactions on the private side or the public side, and other different strategic decisions. And so, what kind of stuff am I looking at on a day-to-day basis? We're looking at a couple of companies that might want to go public now. We're talking to multiple parties that are trying to figure out if they can raise private capital, and we can help them in that private capital process. And then I have probably 100 public companies that we cover in some form or fashion, and we're constantly trying to talk with the executive management teams at those companies to talk with them about the state of the market, what capital options they have, what we're seeing in the market as far as kind of new capital options. Can they sell equity today? Does it make sense? And then when they do it, we hopefully are involved in the process of helping them in raising that money. It's just kind of a slide that kind of says what the previous slide says, which is we help with all these different kinds of things. And there are investment bankers that cover all different, yeah.
So going back to the last slide about investment banking, typically what I think personally when I hear investment banking is from like long hours up in New York, you're really grinding like 80-hour weeks. That's kind of what I've heard. So is it different in the real estate side of investment banking, or is it still like crazy hours that I've heard about and like from friends that have done it? That's just the general knowledge that I had about investment banking coming into this, I would say. So I'm just curious,
Yeah.
Could you attest to that maybe?
Well, I mean, I hate to dissuade people, but yes, it is. What we tell the analysts that come into our group is that they need to think of this as an opportunity to learn, and they're going to come out of it with a really good learning experience the more work they get, right? And there is a huge demand that is put on young people in our business. I don't necessarily know why we don't have twice as many people. Well, I do know because it costs me twice as much to have them, right? But the people that come in and go to work for us view it as a huge opportunity to learn a ton, hopefully work with decent people, good people, at a very high quality firm doing very, very high quality work. And they work hard. They work, I don't know, midnight, 10, 12, pull all-nighters, work all weekend. But, it's not to say that I don't still do some of that stuff, right? It's a demanding, competitive as hell business, as most businesses are. Folks have to have a phenomenal attitude. They have to care. We say to everybody that joins us, work ethic and attitude. We're not curing, I said this earlier tonight, we're not curing cancer, and we're not putting people on the moon or Mars or anything like that. We're doing real estate. I mean, there's nothing that mentally people in here can't do. The tough mental part of it is the grind. And it is a grind. But you know what? So is being a medical resident, right? The people that go through investment banking programs have opportunities that maybe they want, that we put them on the path to get to. I mean, they've gone to the biggest private equity firm, they've gone to Blackstone and KKR and TPG, and we've got people that are VPs. One of former graduate of not this program, but of the Lisa Ramey, who may have come in and talked to at different points in time. She worked on our team, and she's a VP of Finance at Xenia, which is a hotel REIT in Orlando. And she's phenomenal. She should be CFO someday. We've got another person that I work with, Doug McDonald. He went to Georgia undergrad, but he's still a good guy. And he's working at the same position at Columbia. We had a person that left that worked with me as my colleague that went to be president of one of the REITs that we did. Had a great run, sold it to Blackstone. He sold the company to Blackstone for $8 billion, and he's younger than me and doing what he wants right now. He made a good choice. He chose wisely. But it's a grind. I mean, it's not New York. There's there's a different culture in New York, and look, I'm not saying that don't go to New York and do investment banking. It can grind you up, and you got to mentally be prepared for that. And some people feel like they want to try and go test themselves and go through that grind. We like to think that we don't expect anybody to be at work if they don't need to be at work. One of our analysts had his wife had a baby this week, and he's been out all week, and he deserves it because he's been working his tail off for 6 months on a deal. But it's a lot of work. So real estate is just one part of this is Raymond James Investment Banking Groups. It's probably looks similar at most of the other major investment banks in the country, Goldman, JP Morgan, Morgan Stanley, all would look similar. You have industry groups that cover different industries, whether it's communications, technology and services, consumer retail. That's an all-encompassing kind of thing that includes boats and restaurant companies and so forth, energy, and then real estate, colored differently. And then these are product groups that kind of work along with us oftentimes to try and provide services to those companies. This is just an overview of the Raymond James, semi-commercial and Raymond James. We've been fortunately very, very successful over the years and have phenomenal client relationships. We have a team of, I think there's 16 professionals on our team now, just in the investment banking group, but we work with the research teams that probably have 16 people. We work with the equity capital markets team. We work with Raymond James Bank. We work with a number of different constituencies within Raymond James. So to say there's only 16 people servicing our clients is just not close to being true, but those are the people that are in our group. We do a lot of private capital raising. We do a lot of probably more public capital raising. We've been pretty successful in some large-scale M&A deals that we've been involved with. Here's a chart of a bunch, kind of give you a sense of scale of how many deals that we've done, 2003 to current. So 2003 was coming out of you were mostly young then, coming out of the tech bubble in the late 90s, early 2000s, that went up and then it crashed. And then you had 9/11, and you had a confluence of events economically with the Fed lowering rates significantly and a push again into real estate post, like in 2002, 2003. So that's when IPOs stopped. Real estate IPOs stopped kind of in 1998. I think there's maybe two between 1998 and 2002, 3. And then it kicked off again, and there was a wave from 2003 to 2006, 7. And then there was a big takeout wave right before the financial crisis when a lot of private equity firms were taking companies private. And then there's been a little bit of a wave again out of that, but not as much as we'd like to see. Candidly, new business formation has been slow in the public REIT space. It's gotten more and more difficult to do these deals for smaller cap companies because of if you look at a company like Regency Centers, which is a public REIT based in Jacksonville, large shopping centers, retail. Raymond James was involved in their IPO, and that was before I got there, so I want to say it was 93, 94. They raised $100 million. I don't know what they had, maybe 12 assets or 16 assets, right? I mean, there was nothing. Now they own hundreds of assets, and they're a multi-billion-dollar company. And so another company coming in to be that $100 or $200 million company, it's very, very difficult. So we're at a much more mature stage for the four main food group kind of industries: retail, office, industrial, multifamily. But we've seen more niche kind of deals happen. So here's a list of those deals that we've been involved with. And Americold happened this year, right there. That's specialty warehouse, refrigerated warehouse stuff, kind of a specialty deal. Safety, income, and growth. That's a land lease deal. So all they own is the ground that's land leased on a long-term basis to asset owners. It was spun out of another company that we know called iStar, but it's a very, very specialty niche business that we were involved in. Clipper is a company that owns Not a lot of assets. I think they own 5 or 6 assets in New York City, but it's New York City multifamily. Invitation Homes is a single-family rental company. That's the Blackstone entity. This is a skilled nursing, MedEquity, skilled nursing. American Farmland is farm. There's only one farmland REIT. Yep.
With any of these deals, was there a point that you thought like it just wasn't going to go through and then it ended up pulling through?
Yeah, all of them. That's the other thing about this business. It's boom, it's bust. So it's Americold tried to get public probably 3 times, I think, over the course of the last 10 years. Safety Income, it was a little bit different story, but it was a spin out of a company called iStar. Clipper barely got done. It really got done because Raymond James could do a bunch of retail and sell it to our retail system, and not we don't think we sold it appropriately there. It's just that we have the ability to sell it there when the institutional orders don't come through. So yes, and a lot of these deals, and I think as many of these deals as you see up here, there's 3 times as many that didn't end up happening. Jernigan Capital's a self-storage company. I mean, yes.
What type of real estate companies actually look forward to go public?
I'm sorry?
What type of real estate companies, maybe developers or investors, what type of companies look forward to go to?
To go public?
Yeah.
So give you 2 examples of things that we're working on now. I'm working on there's 2 IPOs that we're working on right now. I don't know if either one of them are going to work, candidly. One is a great company out of New Orleans that's called HRI, Historic Renovation Inc. They call themselves HRI. They have done a lot of historic tax credit deals and multi-use, heavy redevelopment of older buildings and for major reuse. So they'll take an old factory and turn it into multifamily. They'll take an old building that's closed down and turn it into a hotel. We did that in Minneapolis. I got a lot of assets in New Orleans. That company they've financed themselves with private equity. So they have 2 private equity partners in that deal. One's called Almanac Realty Investors out of New York. Another one's Stepstone. And those guys are kind of out of money they're at the end of their checkbooks to fund this entity. So they don't really have any more growth capital from those 2 firms. Their question is, do we go try and find other private capital? That valuation process to bring a 3rd private equity capital partner into the entity is challenging at times, right? Because you have 2 big private equity owners and you have to agree on valuation. So what they would like to be able to do is go public and get perpetual capital, pay off their 2 private equity partners who their cost of capital is pretty high, and then continue to grow this company and into perpetuity, right? And if they're not able to do that, they might have to either sell the company or it's unclear. And so their number one choice is try and go public. They're going to try and raise $450 million and pay off their 2 private equity guys and have some growth capital to continue to grow. Another one is that office company that I was telling you about, they own about 15, 20 office assets, and they're out of money from their friends and family kind of network. And so the next capital raise that they do, maybe they can go raise private capital, maybe that's on a one-off basis, but they don't own or control it. I mean, the guy that the people that give the most capital end up having the most control. So if we would go out to try and do a deal and we find a 90% equity partner, a pension fund or somebody, at the end of the day, they're going to have control. They get to decide when to sell the asset, if they sell the asset, and all those types of things. And so you can end up having assets sold out from underneath you if you're a real estate owner, right? You don't control your own destiny. Yeah.
If someone comes in wanting to go public, what's an indicator to you that is absolutely not what route they should take?
People's a big one. Size, sector, valuation, desires. I'd say the biggest, easiest screens are kind of size and people initially, and do they have a good sense of what it is that they're really getting into.
Do you find you have that conversation often, or people kind of have a good idea of?
Yeah. I think the people conversation is probably a little bit more difficult for conversation to have with people. Size is one that people can understand, and certainly valuation is one that people can understand, because at the end of the day, people think they want to go public, and then you tell them what the valuation is, and they change their mind a little bit. But there's all kinds of, one of the most successful companies we ever had was a company that came in as two guys that owned parts of 3 assets. And that was back in 2003 when you could do a deal like that, and they were in the life science space. So they owned laboratory space that was rented out to pharmaceutical companies and that sort of thing. It's a company called Biomed. We did an IPO for them, and we raised them several $1 billion of capital over the course of a handful of years, and then ended up selling to Blackstone. It was an awesome story. And they were great people. He had experience being an executive at the only other company that was like that. It's a company called Alexandria. And he had sold a portfolio and had spent some time at that company. So he had track record stuff that you could sell. M&A advisory type stuff. This is also a big part of our business, a big part of investment banking business. This transaction, Pebblebrook right there, that was 4 years of work to try and get there, really 20 years, because the relationship with the CEO goes back 20 years, and then with the CFO about that long. But we first started running different M&A models for them on a number of different things, 4 years ago. Then we did some in the fall, and then I was on vacation with my family, and I got an email from the CEO saying, "Hey, can we put a letter together to make an offer on another public company?" And so that was the December 18th. And we ended up sending a letter to the company on March 6th and made up privately, and tried to get them to engage with us in conversations. They quickly hired a law firm that was focused on defending them, as well as they hired Goldman Sachs and Citigroup to try and defend themselves, as they viewed us as an unsolicited, hostile kind of proposal. We didn't view it that way. We thought it was friendly, but I guess when you try and take somebody over, they view it that friendly. And so then that went public. We made that. They said no to us, and we made the letter public March 26th, something like that. And then it was on, and it was a 6-month. And I'd say 24 hours a day, 7 days a week, you had to be on. You get stuff. I mean, you're always thinking about it, you're always doing it, you're always working it. And eventually they decided to sell the company to Blackstone, even though we were offering a higher price. It should be a case study. I'm telling you, somebody's going to do a case study on I got to be careful because it's being talked about, but on what I believe was poor board behavior and corporate governance. And so the board had our CEO used to run their company. He had left. There's all kinds of dynamics, but there was a real reluctance because we had made an unsolicited offer for them to do a deal with us. So they accepted a deal at a lower price with Blackstone. We thought that was extremely unreasonable. They were trying to go forward with it. We filed a vote no proxy and continued to fight it. And eventually they agreed to do our deal because they were going to lose the vote from the shareholders. But I think the lesson there was all the way through, Blackstone was going to buy the company at $33.50. From the time they made the offer until they finally agreed to us, their stock never traded below $33.50. It was always trading at $34.50, $35, above $35, because shareholders believed that the company was worth more than Blackstone was offering for it. And the board just would not do the right thing until they were forced by the owners of the business, the shareholders, to do the right thing. And you don't often see it. I mean, I've been doing it for 23 years. I'm not aware of another deal in the REIT space that's been like that. But that was a really fun, entertaining, life-consuming transaction. This deal was an awesome deal too. That's the Catchmark deal that was a large timberland M&A deal where we bought a large portfolio and then put all the capital together behind it. And some of these other deals up here, you know, they all have their own little stories, but there's a lot of M&A, both buy side. So we were the buy side client in this one and this one, as well as some sell side stuff. That's Blackstone buying BMR. And some stuff on the single family rental side, the timberland side. This is a retail deal right here. This is a specialty retail developer in Southern California, mostly in the LA area, that has the principal is Hispanic, and he has a real focus on developments in predominantly Hispanic areas. And Federal, which is one of the premier REITs in the space, ended up buying that company, their assets, and then continuing to fund some development deals for them, which is I think a great outcome in a lot of different ways. Overview history of REITs. How are we doing time-wise? Oh, what time do I have? 5:30-ish. Anybody here 6:30? Do you rate the speakers based on the length of their conversations? I mean, I don't know where everybody's going after this. I assume dinner or the bar or studying. But so I can wrap up. I know what I felt like when I was in your seats. What's that? Oh, you have more classes tonight?
Yeah.
Do you really?
Isn't that crazy? No?
Don't let them whine.
Oh my gosh. And more classes? What class do you have tonight?
Studies.
What, space studies? I was going to say, I didn't. Case studies. So you like real estate oriented case study stuff?
Yeah. I can give you more detail later.
Oh, that's
Yeah,
great.
Changes from semester to semester.
Good. Anybody have stuff they need to do before that you're trying to do it right now? So history of the REITs, I don't know how much you know. I'll give you a quick overview. Yes. Oh, I thought you were raising your hand. No, I don't have a question. It's okay. I was begging for a question.
Before you go into REITs, could you talk a little bit about how you get paid? I mean, not you, but investment bankers in general. I mean, whether it's IPOs or SEOs or as different from the advisory services stuff. So how do you get paid?
So advisory services is easy. We just get a fee that is either a percentage of the deal or percentage of the capital raised and that sort of thing. For public deals, you typically get paid by a gross spread that's paid by the company. And so if the company is going to do a deal, and let's say their stock's trading at $20 a share, a normal spread for a follow-on offering would be, so that's a company that's already public. If you do it, and it's lots of structured, but a normal fee, let's say, would be 4%. So we would sell the stock to an investor for $20, but we would give the company $19.20. All right, and we just keep the gross spread in between. So that's the main way that you get paid when you're doing equity deals, offerings, or debt deals. You get paid a spread off the proceeds from the company. So in effect, the company receives a lower net price for whatever security is that they're selling. And that interestingly, from when I started in the business to where we are today, the spread compression, the compression of that fees has been enormous. So as I told you, we did 2 deals this week. We did a $1 billion deal for a data center company on Monday, and then we did like a $500 million deal for another company on Tuesday. The spreads in those deals, I think the spread in the larger deal was 3.5%, and the spread on the deal on Tuesday was 4%. But there's lots of different banks participating in that, right? So unfortunately, it's not all going to Raymond James.
And on the advisory side, if the deal doesn't close,
right? So this deal, or that lodging deal, I couldn't even, I mean, the firm's probably going to make $2.72 an hour, even though we're making a really good fee, given the amount of hours going in. But we had, I mean, it's a huge bet alongside your clients because it was either feast or famine. It was a zero. So, and that's true on a lot of public company deals too, right? If you don't end up getting them done, if you go out and you try and do an IPO and it doesn't get done, you've got a lot of legal expenses that you're obligated to fund because you have underwriters counsel, you have counsel that represents you. So, I mean, we've had deals before where we're running up pretty significant fees that we don't end up being able to recoup. Yeah.
What's the most interesting deal you've worked on or been a part of?
That Pebblebrook M&A deal was the most interesting deal that I've done. We had Goldman Sachs and Citigroup and a firm called Goodwin Procter, which is probably one of the top 3 law firms in the sector, representing the other side, all not wanting to do what we wanted them to do. We had Blackstone, who was the winning bidder. It was a great challenge. It was super fun, but hugely taxing. Hugely taxing on you mentally and physically and everything, right? I mean, and a part of this is, you talk about investment analysts and going through all the stuff they're doing. I mean, unfortunately, that's just the nature of our business. And I think that when the early years to go through all that stuff is to get beat up. There's a little bit of training to know that you do this kind of stuff, and sometimes you go through these ebbs and flows from a career and professional perspective. And that would have been a big bummer if we wouldn't have gotten it. And big bummer. Yep.
Is that spread compression of what you're charging your customers? Is that due to less amount of deal flow, or is it due to a larger amount of competitors in the market?
I think it's due to a more mature industry across the board. The public investment industry has become much more mature, and with the evolution of the amount of transparency that exists today, it's hard for me to comprehend still, but it's much harder for you all to really comprehend. When I started in the business, if you wanted financial information on a company, you had to write them and get them to send you a 10-Q, right? I mean, that's how you got financial information. You didn't click on a website, open, there it is. If you go to any of the public companies today and you look at the investment materials that they have online, you can get their 10-Q, you can get their quarterly supplement, and you can get an investor presentation that's usually within 2 months old, 2-ish months old, right? That provides huge amounts of information for the investment community. The investment community, on the other hand, when I'm saying that, I'm saying the mutual funds, the investors in these companies, it's become so mature that they know the companies oftentimes as well or better than the investment banks do, right? So if you take the biggest money manager and the dedicated kind of money manager that invests in REITs, a company called Cohen & Steers, it happens to be a public company. You can look up their information. And that firm is dedicated to try and understand the public companies and real estate and what to invest in and at what values. And so they have their own models on every one of these companies, and they've got so much information. So when you're going out there with a deal, it's just the information dichotomy or void doesn't exist as much anymore. And so with the more availability of information, I think what you were getting paid for before was sometimes providing you information on a company and giving you an opportunity to invest in it. And today, all of it's so fast, it's so quick that you can raise $1 billion overnight, or you can, in a day, I guess, or $500 million overnight. It's all moving so fast that from a competitive perspective, other banks started, in order to win the business, I'm bidding 4% for a deal and you bid 3.5%, right? And then somebody else says, I'll do it for 3%. And then somebody else says, I'll do it for 2.5%. And now what you have is what's called at the market offerings, which, so this year, just looked at it yesterday, this year REIT equity follow-on capital raising is down 70% from last year. Number of different reasons, mostly because the sectors, our public sectors are getting outcompeted by the private sectors in a lot of places, so it makes sense to raise money. But of that money that's been raised, 2 times more has been raised in what's called ATMs and what's been regular follow-on offerings. And what is an ATM? An ATM is it's an at-the-market offering. You call it an ATM because it's like an ATM. I mean, literally for companies, they put a program in place. They file a registration statement, and they call us, one of my colleagues that I work with, that does these trades, and they say we want to sell $20 million worth of stock today, and that stock goes into the flow of what happens on a daily basis. So usually if you would go and buy a share of stock, and let's use Regency Centers as an example, just maybe Simon, some of the other REITs that you might know. If you go to buy a share of Regency, and you call up a financial advisor or whoever it is, your broker or whoever it might be, and they buy 100 shares of Regency, it used to be that you always knew that you were buying that stock from somebody else that was selling it, right? I would be selling it, you would be buying it. Today, for a lot of these companies, for a lot of these situations, companies get in the middle of that flow. And so when you're buying 100 shares, you might actually be buying it from the company and not know it. The company is the one that's selling it through the trading desks. And so with the evolution of that, people are willing to do that business at like 1 point, 1.25. And it's just, you know what I mean? You're doing a 4% spread business, and now you're doing 1.25% spread business. And 2 times as much is happening at 1 than is happening at 4. That's not a good trend if you're want to make money from that business. But it's good for the companies, not as good for the investment banks. Somebody else have a question? Yep.
You said capital raising is down 70% this year?
Correct.
That's a lot. So can you go into more details about it?
Sure. So public capital raising for existing public companies, it usually makes sense to sell. Here, we'll go. Well, let me use a slide, and we'll get to it. So you've got equity REITs, you got mortgage REITs. Here's the layout of the REIT sector that maybe we'll come back to, and some of the companies. Here's the research universe. So valuations. So it makes sense for companies to sell stock. When they're stock, you can look at what's called NAV. So here's how REITs, this big picture, right? I tried to just make it super high level. You can value a public company just like you value a real estate asset, any real estate asset. Right? So you value in a real estate asset. I don't know if you've gotten into cap rate valuations and IRRs and equity IRRs and that sort of things, if we've gotten to that point yet. But a simple way to look at some of real estate, and it's shorthand and you don't like looking at it, but unlevered returns on cost. Think of it as a cap rate, right? Your NOI, your net operating income over the cost of the asset. and so if you have one asset, it's easy and not difficult to look at that. If that asset's producing NOI of 10 and you buy it for 100, you bought a 10 cap, right? If you paid 200 for it, 10 over 200, you bought it at a 5 cap. That's probably right around where multifamily's trading today. So let's say a 5 cap. So you have multifamily properties producing $500,000 and you buy it for $20 million. If you take a second property and a third property and a fourth property, all you do is you add those NOIs together, right? And then from a public company valuation perspective, what you do to figure out how a company is trading is you take the number of shares that are outstanding times the share price, and that's the value of the equity market cap of the company. You add the debt, make some other balance sheet adjustments, and then you can figure out, well, I've got $50 million worth of NOI coming out of this company, and it's trading at $1 billion, right? So it's trading at a 5 cap. And so what happens is that public companies, if I'm trading at a 10 cap, my valuation is at a higher cap rate, and I can buy assets in the marketplace at a 5 cap, then if I sell stock and buy assets, I'm actually decreasing the value of my company. I'm diluting the owners of the company from a value perspective. And public companies typically trade somewhere between 20% plus or minus of NAV. And that's what, like if you go through and you value the assets of the business, like I said, the real estate, and then you look at what how it's being valued in the public markets, that valuation, when you go back to the equity side, and so that people think of NAV as an equity one, but when you go back, it's usually trading somewhere between plus or minus 20% on a levered basis, which would probably be at a 50% leverage, plus or minus 10% on an unlevered basis to what the real underlying value of the real estate is. Today, most of the core sectors are trading at discounts to NAV. So Simon Properties or Taubman or Macerich or Regency Centers, shopping center, retail-oriented companies don't want to go sell their stock today to go buy more assets because it's dilutive. It doesn't create value, it impairs value. And that's true for a lot of other asset classes. And the reason, multiple reasons, but one of the big reasons today is that money is generally easier to get for private companies. And the private companies can outcompete the public companies for assets because they tend to lever the assets at a higher level. And so private investors will lever assets at 70 or 75% with lower cost debt. Public companies, for the most part, want to lever below 50%, some as low as in the 30s. And so the returns, the private capital can pay more for the assets than the public capital can. And thus you get less companies willing to issue stock. So if we could get the stocks to go up, the stocks would go up, and these companies were trading at above NAV, they'd be issuing stock. So, do we have data centers on here? I guess I don't have data centers on here. Maybe I have them over here. And it's different information, but the data centers are trading at premiums to NAV. Manufactured housing is, but most of their capital raisings happen on the ATM side. But not a lot of sectors are trading above what they can buy assets for in the private markets. Yeah.
Since it's such a common topic, I was wondering where you think that real estate is going in the next 2 years.
Oh gosh. As I said at the beginning, I don't see any huge black clouds other than what the Fed has done both in the US and central banks have done around the world as far as priming the pump massively with money printing. And I think that you got a boost undeniably by those short-term, the interest rates, particularly short-term interest rates for an extended period of time being depressed by central banks. And then that you also have kind of, I think, what's helping a bunch, and look, it's just my opinion, but as you look at what happened with the tax policies and the tax changes that happened a year ago or whenever this year, I can't keep track of it from a political perspective, but when you take a bunch of money and you before you were sending it to the government, but now you're keeping it in the private sector's hands, whether it's individuals or corporations, that provides more money for the economy, particularly if the government doesn't change its spending habits, right? I mean, it used to be that if the government didn't collect as much money, they didn't spend as much money. I don't think that's true anymore. From a fiscal perspective, we could sit around and argue forever whether it's a good idea to run trillion-dollar deficits when our unemployment is at an all-time low. 20 years ago, people probably would have said that's a bad idea, right, long term. Today, everybody's living on the 5-hour energy, and it feels really good. But if, I've been wrong for a long time about what happens with interest rates and that sort of thing. So I don't see huge supply-demand imbalances because of this. I see price inflation because return demands changed for people, right? If you price debt at zero, or if you earn, I used to give the guy that runs Raymond James Bank, I used to give him a hard time because he would give us a hard time about the pricing on some of the loans that our clients wanted, right? And he was always pushing back. And the main source of a bank's capital is deposits. He was paying 2 basis points on deposits. I said, if you can't make money when people are giving you money free, then you guys have a problem. But for a long, long period of time, short-term interest rates were so low that people would accept lower returns for a lot of different things, right? I'll buy a net lease Walgreens for a 5 cap if all other returns are low. But at some point in time, if return demands and hurdle rates go up, then cap rates likely go up along with them. And so as debt rates go up, it has a 2-pronged factor, just like when they came down. It makes it harder for the equity to make a return, and it also probably raises the level of return hurdle rates that the equity wants. I mean, you talk to private equity guys, they tell you that they're still trying to get 20s. They haven't tried to get a 20 in a long time. I mean, 15's the new 20. 12's the new 20. So if that changes, the cost of debt capital is such an important component of real estate, whether it be commercial or residential, that if the cost of the debt changes, it will have an impact. It will slow things down. I don't think that we have today this massive overbuilding in any of the sectors. I mean, you might have overbuilding in multifamily in this market or in that market, and industrial maybe gets there, but they can build industrial so fast that you don't seem to get overbuilt in industrial, because you got industrial parks sitting out there, and somebody else is going to put up another 150,000 square foot industrial building, and they can build in 6 months, right? Problem you often get with overbuilding in major metro markets for office and hotel and that sort of stuff is the lag time is so long. By the time somebody gets to the point where they're really starting to put a shovel in the ground, the cycle is turned, and they probably shouldn't, except they're in for a penny, in for a pound. I mean, they got all their money in the deal. It's like all my money's in, so I'm bringing the debt money and everything else that I can get it. And if there's one thing I know for sure, it's that developers, and God bless you if there's developers out here. I love developers because they're the most optimistic people in the world. But developers will build if you give them money. It is that simple. They will build if you give them money, and so the only governors on developers is really capital sources. And I think there's been pretty good governors on that now. I don't see anything big, so knock on wood, we've got more good times ahead. That being said, dislocations aren't, they're bad for some things, but they're not bad for others, right? I mean, there's a lot of glass is half full kind of stuff when you go through different points of the cycle. And so there's ways to make money and be successful in all points of the cycle. Yeah.
In this kind of uncertain climate, what are the most active private equity sources you've seen? And has it been more domestic or more foreign?
Well, there's a lot more domestic capital that's invested in the U.S. still. I mean, you have large foreign capital sources and large, the sovereign wealth funds and so forth. They're looking to deploy such large capital. And we had a client called Strategic Hotels that was actually bought by Blackstone and then flipped to the Chinese, and then to Anbang, who also happened to bought from Blackstone the Waldorf, which if any of you have gone to New York, you should walk by the Waldorf at Park and 49th or something like that. This huge, iconic hotel that has, entertained presidents and everybody forever. It's boarded up, and it might be boarded up for another decade. Who knows? I mean, the CEO of Anbang, I think, is in jail. So because they're running all kinds of problems with the way they were raising their money over there. But it's mostly U.S. private equity funds, I'd say, that are funding it. And for a long period of time, after the global financial crisis, I'd say early on after that, there was a funneling of capital to the largest private capital sources, to the 10 largest guys. And so take a Blackstone or KKR or Apollo, those names that you hear, they are the ones that got most of the money, because it's just way easier if I'm a person running a pension plan for North Carolina or Florida or state of Texas or whoever. I've got a choice to invest in Blackstone Real Estate Fund 7, the $15 billion global real estate fund, or I have a chance to invest in a $300 million fund that the three of us are running. And we're really good and we've got some good ideas, but Blackstone's got this shiny stuff, and they're good. They're smart people too, but it got so concentrated. I think it is starting to funnel down to smaller funds, and other people are able to raise capital because, again, I think we're a bit flush with capital right now on the equity side. So, yep.
You alluded to it at the beginning, but I don't want to jump the gun. But could you share some of the trends you see in retail?
Oh, in retail. Well, I mean, I asked this to the group before this class. I mean, do you think you buy, like, let me see your hand. I got to get interaction from everybody. Do you think you buy more than 25% of, let's say, non-grocery stuff, more than 25% of the stuff that you buy online? More than 25? I do. More than 50? Yeah, I mean, I think that trend is going that way. I stopped in a retail center on Archer Road as I was driving in here real quick, and the tenants in the retail are all restaurants. Retail is trying to find services-oriented business, restaurant, that sort of thing, and not things that are selling stuff. You don't have boutiques and that sort of thing. I bet you 80% of the stuff that gets bought in my house, and it's not by me, but my household, comes online. I know because my dining room isn't a dining room anymore. It's like an inventory exchange place, right? I mean, it's literally, it looks like it's just got boxes that are either coming in or they're going out. And I've got two boys, and they try stuff on, and that fits, that doesn't, that fits, okay, ship it out. And that's why there's been a huge movement in industrial. Industrial real estate is hot as can be. And retail, there are lots and lots of questions about what's going to happen to it. Your A malls in sizable cities, Tampa, you have a handful of malls that probably work, and then a lot of them that don't. The Oaks Mall, we were talking about it. Who goes to the Oaks Mall for fun? Anybody? I used to. I had a great 3-for-1 at one of the bars out there when I was in college. But it's what happens to that mall, what happens to that retail, and there's a lot of people that spend lots and lots of time on it, and I'm not an expert by any stretch. But I believe that well-located real estate will always work. Well-located real estate. If you're on the wrong corner, on the wrong street, you're a block off the strip, if you will. I don't know if it works. If you've gone to Vegas, want to be on the strip or you want to be off the strip? Lots of people make that gambit to go off the strip. Lots cheaper, right? It has to get enough cheaper for it to work. And at some point in time, maybe it does. Maybe the cost of the real estate, I just don't know if the cost of the real estate is enough of a difference in a lot of these businesses to justify going off prime location for a couple of $3 a year in rent per square foot, and if it makes sense for you as the tenant to do that. Or I guess it depends on if you're going to pay, I'm not saying you need to go to Fifth Avenue, okay, whatever the rents are on Fifth Avenue, but there's a happy median. You know, it's the evolution of what we're part of today is, it feels like life, but it's hard to appreciate. I don't know if I said it in here or not, but I didn't have a cell phone when I started work. You know, I mean, we rode horses and buggies. But technology and the evolution of how people interact with each other and interact and buy things, it's changing. How's it going to change if you get autonomous vehicles? I mean, how's it going to change if you get to a point where 20 years from now, either because of Uber or Uber with autonomous vehicles and so forth and so on, people don't have cars, right? I mean, what's that mean for parking and parking requirements for real estate? You know, I mean, it's going to be dramatic. It's going to be fun to see. I mean, there's going to be winners. There's going to be losers. And I think probably people get way ahead. You know, I mean, it felt like a year ago that, you know, the trend was autonomous cars are coming tomorrow. Right? I mean, you don't want to own anything related to a car. I don't know if that's quite true, but I think it's like a company you guys may know, Blockbuster. I mean, when people saw some of the trends that were happening in digital and those types of things, they said, "Oh, Blockbuster's in trouble," right? "Oh, Blockbuster's in trouble." But it wasn't for 12 years, but then it was like dead. It's like done, right? I mean, so, you got Redbox, I guess. And what happens and how that happens, I think, is going to be really, really, really interesting to see. I mean, it's happening not just with retail too. It's happening with WeWork and with the way that office space is being used and people want to work, how they want to work together. It's in hotel and how hotels are developed and what they're doing with the common space and how they're thinking about the living area in the room size versus the common area, right? I mean, it's experiences versus things. It's all, you know, I mean, you can throw out lots of different phases. How this works is going to be really, really fascinating to see. And how your generation and my kids' generations interact with each other is going to be phenomenal to see too, because, I mean, I don't know. I mean, it's way different.
What are some of the sources that you use to stay current with news? I'm sure you have Bloomberg, Davis, those.
Yeah, we've got, oh my gosh, we got tons of research, different research that we read, macro research, and from multiple different sources. I think, you know, one of the things I was going to say is, people, you go and you say, well, what should you do to be happy in your career? How do you find happiness in what you're doing? And people will say, well, if you do what you love, you'll never work a day in your life, right? I mean, true. I think if you love what you do, you're more likely to find happiness, because if you just look for there's so much, no matter what it is that you're doing, there's so much that's not like the fun part of the job, right? I don't even care if you're a doctor, if you're a football player, if you're a coach, if you're a real estate guy or a private equity guy. There's a lot associated with that job that isn't the glamour, fun part of it. And so you have to learn to care and trudge through all of those little things. And you know, I think that's the advice that I'd give you on that side. But where we're going from a technology and reading stuff, and I mean, I have found, candidly, I know this is probably a bad thing, I have found that like watching CNBC, and I don't know, doesn't hurt anybody's feelings, but I feel sometimes that I'm dumber after I watch CNBC for an hour. Seriously, I think that there's lots of noise of stuff that doesn't matter. I mean, I feel for those people. They get up every day and they go, oh my God. It's like me getting up here an hour and a half ago, thinking you have to talk an hour and a half. They have to fill time every single day talking about the same stuff. And they divert people from things I think that are important. And so The other thing I'd tell you is you just have to really be thoughtful and not take some of these other sources for like gospel. Even the Wall Street Journal, I still read the Wall Street Journal some, but I read it definitely with a grain of salt. In that, when I read the Wall Street Journal and I read about articles on things that I know, I see how wrong it is. And so I think about, well, okay, I know about 2% of the articles that the Wall Street Journal's write. They don't write about REITs and real estate very much. But what they do write about it, they're not very correct. And so the stuff that I don't, when they're writing about tech and and all the other stuff, how wrong are they on that too, right? And they're just people, and they're English majors from who knows where that got a job at the Wall Street Journal, and it's like, go write an article. Right? Okay, I'll write an article, right? But I don't know how. I think you got to get information from lots of different sources, and make sure that you're always questioning that info. Question?
So you had just mentioned that your best advice was to do what you love. So I was just wondering what your favorite attribute to your job role is.
Yeah, I know. I said love what you do.
Or love what you do.
Yeah, which I think is different than do what you love. But then your question is, what do I love about my job?
Yeah.
I think the opportunity to work with the people that I get to work with, that's the biggest thing. Kind of soft, squishy stuff, right? But the team of people that we built, you spend more time with your colleagues than you do with your family. And if you're working with people that you like, that you trust, that you believe are all pulling the rope the same way, that they care, that they've got a great work ethic, and that they've got an awesome attitude, it's fun to go to work. And I have that on my team, and then with the clients that we get to interact with, we also get a great group of clients and people that we work with. And then just the intellectual challenge of trying to take on, figure out, can we help this company? Tomorrow we're going to meet with a company that really wants to go public. I mean, can we help them get there? Is it the right thing? How do we advise them on that? They're hard-charging young people, and they want to do it, and you hate to say no to people that want to do something so badly, right? And usually you don't. They're going to try and find a way to do it. Good for them. So if we don't help them, somebody else may try and help them. But so you have to try and navigate what you think is the right advice for somebody with what it is that they want to hear. Hey, how do I look? You look good. Yeah, shoes. I mean, I don't know. You try and you don't want to bust somebody's bubble, but you want to be honest with them about what is possible, and the fact that, look, I mean, we're putting our time at risk all the time is something that you have to keep in mind too, right? Because that's all we're really selling is time and advice at the end of the day. So, other stuff.
Any last minute words of advice or?
Go Gators.
That was good. That's good.
I think you're in an awesome time for real estate. You're in an awesome time to be in the program that you're in right now. I do think that there's a lot of good out there that I don't see dark clouds. There are always dark clouds, and as long as people are seeing them, and you're kind of aware of the storms, I think that keeps the system itself self-regulating. But no matter what it is that you want to do out there, I'd say, it's hard. Attitude and work ethic, we preach it to the end of the day with our team. Attitude, work ethic, attitude, work ethic. And nobody wants to hear people complain. I don't care how late you were up. I was up late too. One of the analysts came in on a Monday about a week ago, and I knew she'd been just crushed over the weekend. And one of the people said, "Oh, hey, how was your weekend?" Right? And her wasn't response. sorry. It was stuck. It stunk, right? I was working the whole time. That wasn't her response. Her response was good. It's a good weekend, right? She did nothing but work all weekend long. She told one of her colleagues that asked her how her weekend was, how was your weekend? She said it was good. You don't get anything out of saying it really sucked. The other things I'd say, look, I mean, business advice, find out what's important to the people that are on your team, particularly your senior people, and figure out how you can help them. I mean, at the end of the day, if you can help people be successful, whether it's the people on your team or your clients, if you can help them be successful, you'll find a way to make a living and be successful yourself, right? And so helping those people, looking forward, seeing, okay, well, I see what they did and what they needed on this last deal, and I'm going to anticipate that, and here are things I'm going to do, or here's other stuff that I'm going to do.
Thank
that's
you.
it. All right.